to our Wednesday meetup. So we're going to go through who is Massive Capital. We're going to talk about partnering with Massive Capital, and we're talking 2024 planning. What things should you be doing to get ready for next year? And this will be followed by some Q&A. So thanks everybody for coming. Always, you can put your questions in the chat, or we will have Q&A afterwards, and then we'll hang out and answer any questions that you have about this topic or any other topics. All right, so we are super excited. We have the wrong slide again, though. But if you scan it, it goes to the right page. So we are having our first in-person meetup in Dallas, Texas. We have an early bird special that you can get if you scan on there and you go to the website. And if anybody's interested in getting to one of our inner circle tickets, reach out to me or Jasmine. We'll put our contact information, and we have a special offer. We didn't have the coupon code ready for tonight, but we will have a new coupon code ready for everybody. So you can send it to us and we'll make sure that you get it. Gives you a special discount. But this is our first in-person event in Dallas in February 15th, 16th, and 17th. We are super excited. It's going to be a lot of fun. And Jasmine did put the link in there too, if you're at a spot where you can't scan. All right, so let's talk a little bit about Massive Capital. We are a vertically integrated real estate company. We specialize in ground up construction, retail, flex space, industrial, mixed use, and multifamily. We're also an operator, boy, I can't talk tonight, operator of multifamily assets. If you look over on the left, we're involved in equity. We have a brokerage, and the 3 N's means it's triple net leases. So our brokerage is on the retail and industrial type spaces. We also have a property management company in that same vertical. We've been merged with Realty One, which gives us a lot of development. And we're now also doing construction in metal and construction in wood. You may think, what are the two differences? There's quite a bit of difference, that most of the commercial buildings are going to be built where they are in metal structure, very simple buildings. And then of course, anything that is more on the residential will be in the wood. And then we also have a great education program. We will put a link in the chat that you can get some information about our education program. If you look at the map on the top right, those are locations where we currently have assets or dark, and where we're looking to put some assets at some point in time, mostly on the Phoenix area and the Tampa area. It's in development, not in multifamily space, just to let people know. And then so Realty One itself has 71,000 square feet of retail, and well, let's just 500,000 total square feet of retail for 290 million. And then Massive Capital has multifamily. So we have 36,000 square feet, which works out to 1,346 units. We also have 90,000 square foot X space for a total of 175 million in annum. That always gets me excited when you add the two together. We are close to something I thought I would never say, $500 million worth of assets under management. It's pretty exciting, the growth that's happened. I actually just did a summary for myself of all the things that have happened this year. And it's pretty incredible. You know, I knew it was going to be a big year. I had no idea it was going to be this big. So again, you know, connecting with Massive, you know, we're doing massive things. It's incredible, the pace that we're able to keep, and we're super excited to be able to host these webinars every Wednesday night. Next slide, Miss Jasmine. So this is the team behind the team. So another thing that I never thought we'd have a team of this size. So at the very beginning, you have a lot of the folks that you will know, myself, Jasmine, Maria, Candace, and then across all through there in the top, those are, we have our marketing manager, legal counsel, event specialist, a couple of people we need to get photographs for up there. So And then underneath that, we have all of the accounting firm, underneath that, all the real estate folks. And then under that, we have all the construction management, leasing. So Massive Capital itself is really, really being able to go ahead and get great things done. Awesome. And then we'll skip to the next slide. So these are our main partners. So a lot of you know Shirar, who obviously does most of these Wednesday presentations. Mike, who again, if those of you who just joined wondering why he's driving around in a car, he's in Jakarta right now. He's gone over there to visit a friend and some other things. So he's going to be there for a few weeks. And then Sanjay, who also participates a lot. And then on the Realty One side, we have Bo, Alexis, and Pat. So these folks are all part of our executive partnership leadership team. So we're very excited to have this being able to grow as much as we're growing. All right, so if you look on the left-hand side, you'll see all the deals that are happening. So we started on number 10. So we did a 10-acre land development. I actually just shared some of the updated plans with Shirar before the meeting. It's really starting to look good. We got the first stage of entitlement done. We have a couple of more stages, but we got what's called annex from the county to the city area of Georgetown. We did Amberwood Apartments in Dallas, Texas, a Warner Robins, where we came in and we closed a property there. It was 196 units. Then we raised money for X-Space development in Houston, and we're in the final stages of permitting. We did a value add in Denver. We did a retail in Conroe, and we're doing a new development in Katy, Texas. We have a new deal, which is a 506B. So those of you that have a relationship with someone Massive Capital, we can talk about that. And then we have a triple net lease here in Austin. We're just at the final stages. So if anybody is interested, it's a really, really good investment. If you have some funds in your self-directed IRA, we're talking about a 1.72 multiple of your money in less than 3 years, which is a 20% IRR. And then we're just about closing. I think we're going to close on Friday, but we still have a couple of spots left open on, on the back one before that. Sorry, we skipped ahead. The one in North Carolina. You want to go back one slide, Jasmine? Sorry. Yeah, so North Carolina, it's a great one. So if you need some bonus depreciation, this is what we have for you for this year. So it's something that you can definitely want to be able to get into. It is a great property. It has a good story. This is our second asset in this market, and the first asset actually ahead of schedule made its first distribution, which we all know. And today I've got a few that are struggling to make distributions. So we were super excited to be able to do that. This is a really good asset with a really good group of people. And it says on there that it's 100. Yeah, the minimum is 50,000. But again, this is for accredited investors only. If you just have some money that you want to get used right away before the end of the year, reach out to anyone on the investor relations team. Sorry. And then the next slide is Harris Ridge, which is our new development project that we're just finishing. We're going to be closing on that one, and we have a couple of spots left. And if you're looking to get something in the range of a $250,000 deposit, we have investment. We have a bonus offer. So contact one of the folks, but we're going to give you a 10% bonus on your investment. So again, if you think about that, if you invest $250,000 out of the GP share, we're going to be giving you a 10% bonus. So you're talking a $25,000 bonus on top of a 1.72 multiple. Very, very good opportunity for people. I live 20 minutes from where this is being built. I went there last Sunday and drove around the area, and it's incredible. There are 30,000 people, pardon me, that come to work there every day, and there are only 2 permits granted for that particular section of Austin, and we're one of 2. So we're super excited. So reach out. All right. So if you have some land and you own the land and you're looking for somebody to partner, you're going to be able to send that to deals at Massive Capital, Massive.capital, pardon me. So we're always looking for folks that want a partnership on land. Again, we're looking for A-class property. We're not looking for acreage out in West Texas or East Texas. We're looking for areas close to metropolitan areas where it would make sense to put some sort of mixed use industrial retail development. Multifamily. So we co-sponsor with deals. So again, the deals we mentioned, the one in all of the deals, in fact, we partnered up with other groups where we have strategic partners and we bring in some specialty with our GC and our construction. We support them through asset management, and we also offer signing on the bank loans. Sometimes in today's crazy bank market, so for example, on the North Carolina deal, we had to sign recourse debt. A lot of people don't like to sign that. But if you have no plans of not paying your mortgage, which we do, it's not near as critical as you think about it. So, we plan to keep paying the mortgage. It's a very important thing to do. And it's very important for our longevity of our company. And then last but not least, we have an education program. So we have a CRM that we've custom developed for people that are raising capital for commercial real estate. And we've had that all. So we built it out for ourselves, and then we built it for a duplicate copy that people in our program can do it. We have a capital raising certification where you can go through a course. We're connected in with a family office group, and you get all of that training. And in addition, we have basically we call it education to partnership. So our goal is that we're hopefully going to be able to have all of our students become our partners. That is really the goal. So it's the path to GP. I think we've created 19 GPs, if I've got that number correct, in the past couple of years. And these are folks that they were not. This is their first time being a GP. We have several that it's their, second, third, and fourth time. Myself, it was my 9th time by the time now we got through with all the deals with Massive, but it's super exciting. So awesome. And all right, get your seatbelts on. That's what I always say. For those of you that don't know, Sherrard talks about 1,000 words a minute. And so I'm going to leave it to him to continue to the next thing. And again, if you have questions, you can put them in the chat, and we'll also have Q&A at the end of it all. So Sherrard, I'm going to turn it over to you, sir.
Thank you. Thank you so much. So it's good. Again, the whole idea about full disclaimer, we're not accountants, we're not CPAs, we don't have any professional license. Whatever that we talk about here is based on what we're experiencing, and we're sharing with the community to make sure that at least you get a feel, an idea of what's going on in the market, right? So we call it, and that's exactly the idea. And the next about 4 slides that we're going to talk about is mostly on the debt market and what is the setup for 2024, how we are going about it, and some of the nuances that happened in the last 2 weeks or so that has a potential impact for 2024. Next couple of sessions, we'll talk about the equity and the asset management. But this here, most of the slides, I'll talk about the debt. And if we have time, we can get into the equity side. And then, we can kind of go from there. All right, let's get to the next slide. So for everybody who joined our virtual conference, this slide was presented by JLL. They gave us a Q3, Q4 market sentiment. It's a lot. Don't want you to read all 12 of them, but I will highlight the major takeaway. Jasmine, if you click it one more time, which is the number 1, 2, and 3, it's that number 1, no liquidity, no lack of liquidity. We're seeing it over and over, but their expectation is just high. Number 2, rates are higher for longer. From the Massive side, we took a position higher rate for longer late last year, and our position has been the same, that inflation is sticky, it doesn't go away, and Feds are there, so they're not going to let it go. And even though they let it go, there may be quarter points here and there, which is not going to make a difference for any asset that we buy now. But how it impacts is that given the higher for longer, is that we try not to buy a yield maintenance. We try to buy a 3 to 5 years fixed. So we have an option to get out 3 to 5 years down the way, depending on the business plan. So that's where the number 2 fits into us, that we try not to get yield maintenance, even though yield maintenance is cheap or cheaper relatively. We tend to pay a premium price to get 3 to 5 years fixed, and we have an option to get out. Number 3 is the recession price, recession risk underwriting. So that's there. So everybody, the gap that we had, whether we feel like a recession or not feel like a recession, whether rates gonna go up high or not, if you take the emotion out, I think both on the buy side and the sell side, we're getting aligned. So if you look at the left-hand side, buy and sell spread that we have from all the deals that we underwrite, and we have 3 deals in contract, we're seeing on a 6 cap handle on value add almost on all the deals. We're seeing some 7, depending on how deep is the value add, or for new developments, which is unyielded cost cost. So that's 7, and deal flow volume has increased tremendously, and I'll explain why at the very as a teaser to the next Wednesday's case study. And right now, both parties are getting aligned on options on hand, right? Sellers or buyers were waiting on the sideline with lots of money on hand. They were waiting for something to happen. And same with the sellers, they are fighting it through as it comes about. But now the time is up. We are the whole thunderstorm, and right now we are at the storm. We are inside the storm. We are walking into it, and that is pushing. Both parties are getting aligned. So majority of the folks that are on the market, they have to sell, and they really have to sell. And as they have to sell, depending on how they get out. So it is bad on one side, it is good on another side, depending on how you take a look at it. But the philosophy and the whole idea is that, look, all of us here, we investors. Investors has never been a one and done. Investors has been the game of ones and twos all the time. Yes, if we roll the dice 10 times, our goal is to come out winning 7, 8 times, and we're gonna have 1 or 2 missed out shots. So whole idea is that as you go through it, we all have invested in last 3 years. Love it or hate it, it is what it is, and we have lost some value when we have to sell next 12 months or 18 months. It does not mean that we stop. The only way we're going to get the money back if you keep on investing. Like my mentor is to tell me, look, sure, if you lose 1, go invest 9 more. You're going to have come out on the number 10 with all sorts of money. So our whole idea about those educations, the webinars and the virtual conferences and the in-person conferences are that, look, it is be worried, be cautious, but don't stop, right? The moment we stop, it is not going to work out, right? Because once you miss it, you miss it. So keep investing, smaller tranches, bigger tranches, depending on what your risk tolerances are, but make sure that you stay active all the time. And the last one is that it is what it is. Both sellers and buyers, we get it. We're having a candid conversation openly about it. And the brokers, they are done trying getting the most out of it. Beginning of this year or middle of this year, they tried the rifle approach. That I pick a certain set of buyers to get a certain set of sellers and try to match, with the matchmaking. That is almost gone. Now brokers understand where the buyers are. Right now, we're working towards it. So that's the setup, right? This was the setup for coming into the Q4 2023. Now we're gonna switch the topic to 2024. We go on to the next one. Thank you. So before we get into the debt, this is a lot. I will try to hit the high level. I thought whenever we get into underwriting and getting brokers, there are a lot of different nuances. Who are the brokers? Who are not the brokers? And that kind of stuff. So I thought this is the chance we stop and kind of break it down. What's the definition of brokers and how they fit in, right? So there are 4 different kinds of brokers, right? So think about, and behind everything is the feds, which is the agencies, and coming when the money comes out from the agencies, they go to the DUS lenders. That's the one way of saying the Fed is, or they go to licensed lenders. Their full focus is to give us the agency money, and they have negotiated ways of underwriting it, and that is almost fixed, right? So licensed lender from the agency, a lender who is a Fannie or Freddie licensed lender, they already have negotiated how they can underwrite, they already negotiated the pricing, they negotiated everything. So when someone talks about DUS lender, that is them, licensed lender. Second one is a licensed broker. They're not, in other way, they're not exclusive, but do a lot more, right? So I'll give you some examples as we go through. So again, licensed broker is a mortgage, it's a sales broker, but they also holds Fannie and Freddie Mac licenses. So they can do DOS lending plus more, right? They're the licensed broker. And the third one is the correspondent broker, which is a large broker shop, and they are not a licensed broker, but they have brought in enough deal with the agencies. They have a better relationship, which is number one and two, as you can see, right? And they also have a you know exclusive um, some kind of exclusive contract to work with the agencies. So in a sense, I would say correspondent, it's a little bit licensed lender are the closest to the agency. Licensed brokers are the closer to the DUS lenders, and the correspondent brokers are closer to the DUS lenders as well, but a little bit far away from the licensed broker. And the last one is the broker, which is everybody, right? So whenever we go to a brokerage shop per se, and they're the ones shopping around, they're going to number three, they're going to number two, but they cannot get to number one, or they go to number three to number two to number one, or number one, they're just the one shopping for us, right? That's so when we talk about the brokerage, or when you talk about the brokerage, when you talk about the relationship, look at from this angle: who is what, who is who, and how they fit in, right? So I'll go a little bit more technical into it as you kind of go. Now, as you know, the number one to number four, that's where the fees and the rates typically increases and it goes up. So depending on who we are, if I'm a new guy in the block trying to get my first deal out of it, 9 out of 10 times or 10 out of 10 times, I'll be talking to number four, right? If I'm building a relationship with somebody, then I'm going to graduate from number four to number three, right? And then if I'm doing a lot more deals, then I'll go to number two. But depending on the agency lender, and I may have a direct relationship with number one. If you flip it, it's still different, because if I do one agency loan, or if I buy one or two assets a year, then going to number one, I'll be just like any other guy. But if you do 2, 3, 4, 5, 6, 7, 8, 9 deals, it makes sense for you to go to number one. It makes sense more you to go to number two. And or if it makes sense for you to go all of them, but you put them on a different bucket for different assets, right? We do the same thing. We go to brokers. We typically stay between 1 and 3. 4 we shy away for a little bit, at least for now. On the Massive side, we have very good relationship with some of those licensed lenders, really good relationship with licensed brokers and the correspondent brokers. We group them once. Then broker last 4. This is our end all be all. When we can't get anything, we'll go to broker. That's how we take a look at it. An example, if you click one time, Jasmine. So example will be on the right side. So I took a screenshot from one of the websites. So licensed lender, you can see Arbor, Capital One, Chase Bank, Citibank, they're the licensed lenders. On the right side are the licensed brokers, right? So another way, if I go to CBRE, they do debt brokerage, but they are a licensed broker. That means they do a lot more agency plus anything else. Sometimes they have to go to left-hand side. To CBR, you will go to Arbor to get an agency debt, or CBR, you'll go to Capital One to get agency debt. And that's how the relationship works. We are on the right side, and we connect with the licensed brokers. They connect with the licensed lenders. Then we get to the agency. Like understanding the debt structure and who are the lenders and how they fit in, this is kind of interesting, because how the servicing happen once you take a loan, that kicks in based on the lender, right? So for us, for you, it may not have an impact on what you do, but understanding the game a little bit important, because that's how you get, really, that's how you build a relationship, right? Time is precious. We are spending our time, so taking aside is very important. I'll give an example. Let's say Capital One. So sorry, Chase Bank. We're taking a loan assumption. The servicer and the loan assumption is being serviced by the Chase banks. That's one. But for certain type of loans, we don't go to the licensed lenders. We go to the licensed brokers. Like we have certain type of loans for new construction that I cannot get to them directly. Northmark can. We did a refi on a Class A new construction and close to Conroe, Montgomery County, from the R1 side, the Realty One side. That was a $24 million, and the lender or the owner of the equity or the debt, there's no way we can get to them unless you go to Northmark. So depending on the type of loan, depending on the type of asset, depending on the location, we pick and choose who we go. Same thing for you, pick and choose, and don't pick and choose everybody. The request is pick and choose one or two sets of groups and stay very close, right? On that note, I'm going pretty quickly. We share these videos after this, and you'll have it. And as I go through, if you guys have any questions, drop it on the chat. We'll come back and answer as much as we can. And let's go to the next one. So big takeaway as I get to the next one, you have 4, right? So we understand the brokers now. Now we're gonna take a look how the debt market is being proved. On the top right, I took a screenshot. It's this year, coming into this year, how much money agency has allocated for multifamily. That is a directional view of which way market is going, right? So big boys, the big offices, they have all the data what they need. Sometimes I may feel like otherwise, but they know more than us. So from the massive side, we always try to stay closer to the market, closer to the feds, and try to understand from their perspective why they're saying what they're saying and see what makes sense. So coming into this year, from the agency side, they have about $150 billion worth of allocation. So 75. So that was the mandate for them to give out. I don't think so. They have spent all the money yet. So that was coming into this year. Now going into next year, you'll see, Jasmine, if you click one more time, please. Thank you. So 2024 going in, they're not down by, I think it's almost 8%. They went from a 75 to 70 billion each. But then what we saw, the big push on really big push on the affordable type of it. So from the total available play, going in from a 2023 into 2024, we're expecting a similar volume of what we have, right? Because understand, real estate runs on lending, and the core lender today is the agency because other, that market dried out, and they are going to make the market. So from their eyes, they're saying, look, we're going to go to 2024. I have allocated a little bit less than that, what we allocated this year, but I'm biasing towards the affordable. So all in all, if you put together, click one time, Jasmine, thank you. So this is the agency, the underlying foundation for the market, and we're seeing a reduction in volume biased towards affordable housing. Thank you, Eric. And that question is, what does it mean for us? That means, as you know, agency is the most level-headed lender. They don't care how we feel about the asset out the market. They give you based on DSCR. And based on their lending on the DSCR, buying on a heavy pro forma, heavy value add, that is less likely. So we're not going to see heavy value add type assets being bought for 2024. That is less likely, which matches with the market outflow as well, because we're expecting a flat, slightly negative going into 2024, then a flat outlook for 2024, then some increase in 5 and 6, really heavy increase in 6. That matches that. And then that's going to continue. But it also means that given it DSCR, high DSCR requirements, capital needed to purchase the assets will continue to be high. What it means is that 2 years ago, we could have raised 25%. To buy a $10 million deal, we needed $2.5 million, maybe $3 million, then we can buy. Now, to buy a $10 million deal, you need roughly $4.5 to $5 million. So it's double the account, double the money for the same asset. That means that really means as the capital goes up, your expectation for the capital goes up because your risk-free return will require a high return, right? So everything starts with how much money we have, 140 billion, right? For agency, their borrowing rate is high, so you expect a rate of return that plus or more. So our capital that goes into the project by design, their expected rate of return is higher. That means if I would have borrowed at a 3% and made a project at a 15% IRR for the LPs, right now if I borrow at a 7%, for the same LPs, you got to give them 15 plus 3 more, right? 18 to 21%. If I do a project today without a pro forma at 20%, by design, I have to pay less. It's just the way of forcing the price down. So it's not about, so for everybody, don't worry about the price high or low. Look at the margin. And what we call it cash wheel. The wheel has to turn, the money has to turn, right? So that's the point. The higher return expectation will require higher price adjusted for tax and insurance. Now, this is the interesting shift. If someone is buying a an equity position for 13%, 14%. Think about those LP checks before that we had on a Class A, 14, 15%. But now, and that means as LP, I'm taking a risk. But if I'm a large LP check, cutting one check for $5 million, and I'm taking equity position, that means I'm taking extra risk beyond the lender. But then what they're doing, they're saying, you know what? I'm not going to take the risk. If I give you $4 million, I'm going to become a pref. So I will sit in right behind the lender. That means I'm not taking a risk on the performance of the asset, not so much, because I'm right behind the lender and I have takeover capacity if the sponsor team doesn't deliver, right? So we're seeing quite a bit of shift that large check writers above a $2 to $5 million or above $2 million or more, they're taking a pref position more and more so than LP position. That kicks into the larger deals that we're doing. It's an interesting shift. We are running that scenario now, and it's really interesting how that impacts that. And and for that, pref is not for everybody. It is not for everybody that requires a certain type of resume, certain type of background, certain expectation. But pref are typically good for larger offices where they're running a shop much more, I would say, not an individual basis, much more corporate type, which is also why we're seeing the majority of the investors are good chunk of investors. They are not only looking at the resume, but also looking at the back office, because the dominant part of the failure so far they had one or two men show, they didn't have it in the back office. So, and, there wasn't somebody who was looking at the macro, looking at the micro, and trying to put a deal together and matching with this cycle per se, right? So we're seeing investors, at least us, we talk a lot. They're asking for the back office. What's the back office? What's the back office? Not so much of a return, because we understand whatever the return somebody produced last 2 or 3 years, market gave it a lot, right, beyond the performance. So that's what we're seeing. So recap: coming in, we talked about the players of the debt market, and now we know the market shrunk a little bit. Now we'll talk about the next slide. It's going to get more interesting, and this is the super mess that we got into 2 weeks ago. So if you go to the next slide, please, thank you. So reshaping the debt players. Look at the right side. So the Meridian was one of the, so I think Meridian guys are badass. They're one of the most aggressive guys that I've seen, and they do a good job of pushing a deal through together, right? I'll share my stories. But beyond that, on the right side, 2 weeks ago, Fannie Mae came about and said, Meridian, they found a fraud on one of the deals. I heard somewhere on the chatter, maybe it's 50, but they picked one and they went after it. And to me, it doesn't matter what they picked one. And they said, Meridian, you're out of business. And now, why I say it's very important, because look at the note 1. David Brickman, he came from the agency. He came from Freddie. He made Freddie who Freddie is, and then he became a CEO of Meridian, and his company is taking a bidding. So that's a big deal. Since it's a big deal, it's now Fannie Mae said all businesses brought in through a broker or correspondent as pre-review. That means I'm not going to believe what you have submitted, so I'm going to go back and recheck what you have submitted. And whatever you bring in today, I'm going to double check your work, because my trust factor went down. Going back to 3 slides ago, where we talked about that licensed broker, the DUS lenders, and the correspondent. Now we need to go back and shift our focus as much as we can to the license, or if you work with the broker, if you work with the correspondent, we need to ask them how this impacts them, how they make sure that they're going to prep us to get into a loan, right? So that's the interesting play, and that's going to shake up a decent amount within the broker shops. And some of them, I mean, everybody will work more, but some of them will come out better because the market will shift toward them organically by design of this, and some of them will get a little bit more push, right? So it is important for us to understand what happened, and not so much of a why it happened. It happened, good for us, right? Because if someone like Meridian were one of the biggest clients for Capital One, and they do somewhat of an agency, but Capital One spends a lot of money with them, or they spend quite a bit of their money, and they got tagged as a fraud, and that's a big deal, and that hammer is going to go through the whole lending process, and that's a big deal. So for us, for anybody who's taken agency loan, especially if we have a loan today, double check, triple check, quadruple check, make sure that our ducks in a row. And as you move forward, we make sure that we kind of keep that, in mind as you engage, right? That brings us to the next slide. Now, Google it, please. Understand, read a little bit. So here on the right side, I brought in the licensed lender and licensed broker. On the left side,
It's easy, right?
So easy. It's so easy.
and on the left side, it's what we're doing. Stay close to your lenders. Not all relationships are same because they're not same. Like lean in with handful of lenders. Again, going back to those 4 categories, not all lenders are made the same. Don't go to the number 1 unless you're designed for it, right? So look at your setup, then you couple yourself to whatever the 4 categories make sense. Then number 2, underwrite the underwriting of your lenders. It's gonna sound odd. We underwrite the underwriters of the lenders. Not all, they don't all underwrite the same. So I'll give an example. Arbor, that's right there. And at the very bottom in the middle, we have PGIM. Even though you go to them a same asset, they can underwrite it different. They get the money from agency. But if you go to PGIM, they're going to say, I don't like those crazy value adds. If you go to Arbor, they'll love it. And if you go to Chase Bank, they have a slightly nuances to it. So underwriting the underwrite the underwriting of a lender, that is important. So underwrite everything, right? And the third thing is, be active and get early feedback when sending LOI. Don't go post LOI. Post LOI is too late. And number 4, and number 4 is pre-negotiate the rates and the fees wherever possible. We do it. Just because broker is there, it's not that. And for us, we have done 7 deals this year, and we do a lot of deals, and we try to pre-negotiate the rates and the fees wherever possible, right? This may not be available for teams who want to do 1 or 2 deals. So when you partner with others, pay attention to that. Again, underwrite the partners, underwrite the broker, underwrite their underwriting, underwrite everything. Right? At least I like to underwrite everything. So this is from the Massive side. This is what we're doing. And this is what we're seeing majority of the other senior players that they're doing. And when we talk about the other operators, more or less, this is the thematic approach that we have. And we thought we'll just share with you guys. So as you get into the partnerships, or as you look at the other sponsors, qualify them with some of the frameworks that we're sharing with you. It is 6:45. I went through last 4 slides pretty heavily, pretty quickly. So I'll pause. I think I'm done here. So back to you, Trevor, and open for Q&A, any kind of a question that you may have.
I told you to put your seatbelts on. It's a good thing there's not a test later. It would definitely a lot of information. So, and I think Schroer's underwritten me like 4 times. So,
And look, it's an evolution, right? And we all have to understand who we are, what we do, all that kind of stuff. And Trevor, you're too special, man. I don't think I can underwrite you.
No, this is awesome. Thank you so much. It's really good. So what we're going to do is we're going to just again, thank you. I'm going to post it again, but you just put webinar as the code. And so just to give you an idea, and I'll post it in the chat again for our virtual conference. And sorry I didn't have it when we were ready. If you go there, you get $100 off just because it's an early bird. But if you put the coupon code in webinar, you get another $100 off. And that applies for all of the categories. And yes, and these are all on our YouTube page. And anybody who came here, one thing you'll get is a lot of emails from Massive Capital, so pay attention to them. And then before we end this, I'm just going to talk about next week. Next week is networking. So we're just going to have some time where you can come and just check. We'll do a couple of breakout rooms and be able to get everyone. On Massive Capitals, you asked about getting a hold of us. I just put the link in there. It's a discovery call, and you can pick who you want to talk to, what you want to learn about. So feel free to raise a hand, unmute yourselves. That was a lot of heavy information. So
we didn't talk about how they make money. That gets even more interesting. How the brokers, it's really, finance is really fun if you understand this. I love it, but it's just really cool.
Yeah, so there is a question. They don't see Cushon, Wake, and Marcus and Millichap in the right-hand column.
Well, let me pull up the slides. So give me just a second. So on the right-hand side, the licensed broker. So again, that's not a end-all be-all list. There are some misses. I went to some website, took a screenshot, and out of that, so Marcus and Millichap, they're gonna fit into somewhere between a 3 and a 4, licensed broker and the correspondent brokers. The new mark, you see it, so probably Marcus and Millichap will be a licensed broker that you can go. And again, so they're licensed broker, they're not licensed lenders. They're not DUS lenders. DUS lenders or the licensed lenders are pretty fixed. They don't fluctuate much. And
Great question.
and the Cushman, sorry, go ahead.
No, I just said great question.
Yep, that's it. That's a really good question. Good observation. Again, full disclaimer, this is not the end all be all. This is just an example. The left-hand side, the licensed lenders are pretty fixed. They don't move much. Licensed brokers, you know, they come and go.
Thanks.
Awesome.
Right.
So either raise your hand or unmute yourself if you have a question. It's good to see some familiar faces here. Thank you.
Yeah, I see some Jake and Gino folks. Thank you, everybody, for joining. And I had a couple of slides. I didn't talk about it, but that's for 2 weeks from now after network.
Yes, so the recording, I'll post it here again. It's on our WhatsApp channel, not WhatsApp party, YouTube channel.
And then there was a question.
And
By
great
the way, Eric, thank you.
information. Great information, Shariah, and your parties, like, and you always keep us up on our toes, right? Just to catch up with the information you are all sharing with us. So you keep us up on our toes. Thank you.
Thank you. I thought Meridian was a big deal, even though the news didn't get much of a coverage. But I mean, maybe it's a big deal to me because I'm in it. But it's whoever is your broker, just stay close to them. Make sure you are on the safe side. And that went kind of underneath the radar pretty quick.
It did, yeah. It's funny how some things go crazy, and other things don't get any coverage at all. That can have some serious implications.
Someone, we have Patricia asked for the education link. Trevor,
Okay, put
share
that
with
in there.
Sam asked, can we just go to previous investments already closed? Okay. So Sam, I can give you an idea of the total portfolio. So we have from 100% of our portfolio right now, we have fixed rate, and the first maturity coming up, it's our Pasadena asset. That is coming up in April of next year. And the second batch will be the Warner Robinson Macon in Q3, Q4 of next year. On the Pasadena, we have executed our business plan. We increased the values, the NOI. Total gross revenue has, I think we're about 4 years ahead of pro forma, but we got hit by the insurance in Texas. So we held off the distribution after the first one till we do the refi. So we ran all the models on the refi, buy, hold, and sell.
What picture you prefer, this?
Sorry. Okay, that noise came in. So from the Pasadena perspective, we held off distribution after the first one because we want to do the refi. And as of now, we decided to hold the Pasadena. It made sense to refi and then execute go to the business plan for 5 years, which is exit in 2026 and 2027. So that's that. Warner Robins. So Macon, we have finishing the business. We're almost done finishing the business plan. We should be about 96% economic occupancy in about a month. After that, we go into the refi. So we kicked up the refi, running 2 models, agency or HUD. So as of now, HUD is coming up to be better. And we had a business plan to release or do some distribution this quarter after, but we're holding up to get to the refi because we just don't know what the NOI needs to be in today's market and refi would look like. So based on the refi, we'll go back and reset the whole thing. The Warner Robins, we're executing the business plan as well. And so in other way, if you look at the portfolio, the distribution for those 3 assets shifted by about 8 months to 9 months. Beyond that, those 2 portfolios, we have another 5 other assets. They are in line. We are distributing. Our Colorado assets are doing fine. We are distributing. We're ahead of the business plan. Our Carolina assets are doing fine. We're distributing ahead of the business plan. Our new construction is going and in line with the business plan. Our San Antonio Gonzalez assets that is ahead of the business plan that is doing really good. So all in all, we felt like the way we designed the portfolio, we are getting the hits of the market just like everybody else, but less off. But remaining of the portfolio, we are pretty in line with what we have. And also we bought with the debt structure, which was different. And going back, what Trevor was mentioning, we do recourse loan quite heavily. So that is paying us dividend right now. So long way of saying, yes, a part of our portfolio is taking a hit, but our goal is to get ahead of the market, which is if market turns negative, we should have a negative, less of a negative hit. Market comes positive, we should have more of a positive hit. And that is working out so far.
So there is another question in Q&A, and then Tracy asked one in the chat.
Okay, so okay, I'll try the Andy first, then I'll go to Tracy's. And that's a tough one, right? To me, it's about, so we take a look at it. I would say start from you and or your team. The more volume you have, more traction you're gonna get. Because we are here to buy deals, somebody here to sell deals, and lenders are here to do transaction. So as long as you can do transaction, depending on that, you figure out, what it is, right? For us, every time we go to a broker, we do interview. Yeah, they will interview us fine, but we'll do interview of the broker. We'll do 4 or 5 different types of product. Based on the answer, we'll put them in a bucket. Because oftentimes, look, we looked at an office, we could not find the damn debt. We just couldn't. I called one of our friends. Within 2 days, he came back with the lender, right? That's the power of relationship. He was number 4 broker. And then all of a sudden, he found the debt that we needed. So stay close to everybody, give them business, earn the time that they will give us, and then, you go from there. Back to Tracy's. Is there any preferred order for license order? No. Answer is no. I don't have any preferred order, so I don't want to pick a side. To me, everybody has a specialty, and our job is to underwrite them and figure out what the specialty is. And when the time comes, we leverage our specialty. Like everybody has their own small, subtle specialties. And so we try to understand that, and then we kind of go. Should be build relationship license broker.
Yeah, I think that one's build a relationship with all of the above, right?
Yes, all of the above. So we have a full-time in-house capital markets guy. Now, again, please adjust what we say based on the volume that we do. Between R1 and us, we're looking at $150 to $200 million for the assets. That's a big volume. That's probably 15-20% of somebody's book of business. So we have a full-time person. For us, we manage about 17 to 21, something like that, local banks and credit unions that we took loans from. We understand. We call them every 2-3 weeks to figure out what they're lending on. Then we also work with Walker Dunlop heavily. Then I work with JLL locally, Walker Dunlop from Florida. Then also PGIM. Sanjay works with Chase and also Capital One. So we all are managing all 4 of them all the time. So depending on who you are, go ahead.
Another important factor too is local banks have a mandate to invest in their communities. And if you can find a bank that has that mandate and your project fits what they need to do, they're incentivized to do that. That's how they get certain tax breaks or whatever they get for being in a community. They have a mandate. And so you definitely don't want to give up on local bank. I mean, they did the deal in North Carolina, and then we had a small market in Denver. It was done by a bigger house. It was just, you just never know.
So key takeaway for the local bank and credit union, they have something called relationship limits. Understand the relationship limit, and then give them your PFS, everything else, let them qualify you early on, so you'll know the relationship limit. And that is usually under credit unions and local banks, so those are full recourse. The low end, you'll get about $9 to $12 million of relationship limit. On the high end, maybe $19 million, depending on the relationship. But you have a relationship limit. And so when you take a loan, typical conventional way is that everybody signs the loan. That's not the play when you go to banks. Bank want everything. They want to de-risk everything. We don't want to give anything, right? So it's a negotiating. So whenever we go to bank, we ask the question, what's your limit? What's your expectation? Then we look at our team. We said, hey, Shariah, you go first. Mike, you go second. And somebody else goes third. But all of us wouldn't show up because balance sheet is precious. And that's a tool. So you got to manage the tool and keep it clean wherever possible as you go. Good question.
And there was a question about doing business in Arizona. We've looked at a lot of deals and we have several preferred partners that we're trying to do deals with, but just nothing's worked out at this moment. It's
That's
maybe still too hot. I don't know.
No, it's getting there. We're seeing 6 handles in Arizona now. Arizona took a big adjustment right away, just like San Antonio. So they're adjusting. Please ask, are your typical loans a non-recourse? No. We try not to do non-recourse, but if we have to, we'll do it if the deal makes sense. Right? And so we don't do non-recourse for others. We do non-recourse for us only, our deals only, and then recourse is that, right? So last year we did a lot of recourse loans because we chose to buy on a recourse, right? The Q2 last year, mandate from Massive was buy everything on not on pro forma. Just imagine everybody's buying in a pro forma. We're the crazy ones saying, no, not gonna buy in a pro forma. All of a sudden we go from a $20 million deal size to $5 million deal size, everything is full recourse. Pay the dividend today. Then Q1 this year, we flipped the corner. We said, go heavy on a non-recourse, go heavy on a bridge debt. So from the underwriting perspective, we're biased towards bridge, then agency, then recourse. And we don't underwrite anything less than 5%. So that means you want to pay high interest rate. Good questions. That's awesome. So for everybody at 7 o'clock, we turn off the video. Then all questions are push questions. No questions are held back.
Yeah. And we should stop the live broadcast too, which is the first time
Thank you.
Yeah. But we stopped the recording. If you have an otter, we'll kick it out. Just again, the whole idea is that this is anything goes at 7. So again, remember, we do this every Wednesday. Our goal is to share what we've learned. And we want to be open source of everything that we're doing. Doesn't mean we're doing everything right. We don't say that. What we say is this is what we're doing. And sometimes it works. And when it doesn't work, we also share that quite a bit too. We've definitely shared that before.